Well, hi there. Good morning. Today's video is switching gears on you slightly. Um, I've been talking to you about day trading, and that's where my main focus is. But it dawned on me, like, okay, if you start day trading, you're going to start accumulating capital. Granted, at first you're going to pay off bills, and then you're going to start building up your savings account. Eventually, you're going to get to the point where you've got extra capital. And so that's what I want to talk about today. What can you do with that and still focused on financial growth? Okay. So that's what this video is on basically dividend investing and why you want to consider it. So just going through this is true with all these videos I make. They're for educational purposes only. I'm not a financial guru, just sharing with you stuff I've seen, learned, and read about. So, pretty much you can see the words on the page, and yeah, just take it for what it's worth. So the agenda for this, an introduction. We're going to talk about strategy, portfolio structure, expectations, managing, and advanced income strategy. So this strategy is going to be like a two-legged strategy for you. The first part, I think it's going to be pretty much straightforward. So along this the ultimate dividend portfolio that beats the market step-by-step guide. And let's get into it. So, introduction. So, what should you consider doing after day trading has generated capital? Well, just like most people tell you with your job, they tell you, pay yourself 10%. Well, I'm suggesting you do the same thing at each month. At the end of each month, look at what you've gained, your monthly gains, and take 10% of that, and it's still in your brokerage account, but mentally set it aside for your investing. Think of day trading as trading. What I'm talking to you about right now is investing. So your investment portfolio. So what if I told you you could build a portfolio of just 10 stocks, and it's going to pay you a growing income every year, and this income has increased. They've increased their dividends for 40 plus years. Think about that, 40 plus years. And it has a real shot at outperforming the S&P 500. All of these are companies that are on the S&P 500. That's the top 500 companies that are being traded. So most people, what they're doing is they're chasing hype stock. They want to have that sexy, like, ooh, look, you want to share with your friends, oh, I have some Nvidia, or I have this or that, whatever. This isn't hype stock, but uh, what you're looking for is consistency and compounding, and that's what I'm going to show you today. It may not look or sound sexy to your friends, but later on, 5, 10 years down the road, you're going to look back and go, "Oh, wow." Okay. So what you're shooting for is around a 12% average annual return over the long term. Okay. And again, think of this like your rainy day fund. This is your investing. This is your day trading is creating capital. And it's also creating wealth. Don't get me wrong, but you want to keep building up that portfolio, that brokerage account, so that you can trade more amounts or higher amounts. If you can take a couple $1,000s and turn it into, say, 20,000 or $30,000, imagine if you're trading 15 to $20,000, you could really amp that up. But this is your created capital. What do you do with it? And this portfolio, it's built on one simple idea. And here's the strategy. Your dividend portfolio goal: own elite businesses that pay you more every single year. We're not talking about average dividend stocks. We're talking about companies that have increased their dividends for decades. So, what's that telling you? These companies are rock solid. Their management and their board of directors are on track, they're on cue, And isn't that the kind of thing that you want to put your long term, your safe money into, right? Think about it. So, these businesses, they've survived for 40 years. They've gone through recessions. They dominate their industry. They generate massive cash flow. And over time, that translates into serious wealth building. So here's your structure that you're looking at. We'll break this down, make it simple. You're looking at four buckets, if you would, four categories. You have consumer staples, where you're going to put 40% of that budget into. Your industrials, 25%, healthcare, 15, and value and income, 20%. So let's just get at it. Consumer staples, 40%. This is your foundation. These are the companies that people never stop buying from. So that's why they're generating so much income, so much cash. So consumer staples, 40%. Look at Procter and Gamble, look at Coca-Cola, PepsiCo, and Colgate Palmolive. You can look at others. Again, this is just for educational purposes. But if you go and do your research and you learn how to screen all these publicly traded companies, these are the ones that are hitting some criteria, and I'll discuss those here in a bit. But go ahead and talk about it now. You're looking for companies that are trading on the or part of the S&P 500, that they pay dividends, that they've increased their dividends over the last 40 years plus, and also their stock values have gone up significantly. So that's why, because whether the economy is booming or crashing, people still buy toothpaste, they buy soda, they buy all these products. That these are consumables, and this is the stability of this portfolio. Okay, industrials. This is your growth engine. This is where your capital appreciation comes from. So you're going to take a look at Illinois Toolworks. You're going to look at Emerson Electric and Dover Corporation. Again, these are not sexy stocks. If you mention these around your friends at the dinner table while you're out in the restaurant, they're probably gonna go, who? But you just sit back and smile inside because you know you have put your money into something rock solid. You don't have to worry. All right. Think about some of these, like for example, during the dot-com boom, man, people were throwing money into crazy, crazy companies that if I mention half the names today, you're gonna go, who? Who's that? People threw a lot of money into them. These companies, they grow their earnings consistently, they increase their dividends steadily, and they quietly outperform over time. All right, healthcare, 15%. This is your protection. This reduces your volatility and protects your portfolio. And what are you looking at? Simple, easy one. Johnson and Johnson. We've all heard of Johnson and Johnson. Uh, this is a company to consider. Again, this is for educational purposes only, but you know, I did some screening. I put this presentation together based on those criteria that I mentioned earlier. Value and income, 20%. It's your protection. This is your income booster and opportunity play. So what are you looking at? You're looking at Genuine Parts Company and 3M. Uh, they had higher income and their potential rebound they have an upside on that. So your expectations, what to expect, understand the goal, right? This portfolio is not designed to double overnight. It's not to compete with hot tech stops and bull runs. That's what you're doing over on your day trading, right? This is like you're saving. You're creating wealth. Definitely creating wealth. And here's the thing: if you don't want to day trade, don't. I'm not telling you what to do. I'm just trying to give you some education so you have options on what to do. But if you decide not to day trade, you're still probably working a job. If you're working a job, pay yourself 10%. What does that mean? You're going to build this more slowly, but consider looking at this seriously and consider your long-term strategy for your life. So many people, they're just kind of walking through life in a grand illusion, And usually about age 40 or 50, it dawns on them, I'm going to have to retire at some age. And usually it comes before you want it to come. You're voluntold when to hit the door. Anyhow, instead, this portfolio is designed, it generates 2.5 to 3.5% yields starting. Growth income is 6 to 9% per year, holds up better during market crashes, and over time it aims to compete with or even beat the S&P on a risk-adjusted basis. All right, managing. This is even the better part. Do you have to look at this every day? No. Once a year. Once a year, sit down, look at the companies you have, do some simple research, and verify, are they still in the S&P 500? Are they still paying a higher year over year dividend? And and are they performing? If they are, then you just leave it alone. If they're not, sell the one you have and grab the next one that qualifies. But it doesn't take a whole lot of effort. Once a year, you take what, half an hour maybe, during the market dips. And this is key. When the market dips, don't think of, oh my God, my stocks are losing money. If you walk into Walmart or wherever you shop, Target, I don't know, wherever, right? And that dress you've been eyeballing, all of a sudden it's down 15%. Do you think, oh my God, this dress must be losing value? No. What happens in your head? Oh my God, look, this dress is on sale. So, who doesn't want a deal? So that's what this is telling you is during the market dip, focus on buying Procter and Gamble, PepsiCo, and Johnson and Johnson. These are the ones you're going to buy on the dip. Okay. Now, I told you this was a two-legged strategy. The first leg was just that, creating your portfolio once a month, take your 10%, and then figure out. Now, it may be like this month you buy a couple of these stocks, and the next month a couple of the next ones. You have your portfolio, and you just cycle through each one and keep adding, keep adding. So what's the other leg of this? When you get to a point where you have 100 shares of a company, and you will, it may not happen overnight, but eventually you will. All right. When I've been talking to you about trading options, I am buying and I am selling uncovered calls or puts, meaning somebody has put an option out there and I'm buying it. Now, I'm not buying that option to secure the stocks. I'm buying that option because it goes up and down in value, and hopefully the one I buy goes up in value. I turn around and sell it, and I make a profit. No different than if I buy a stock and it goes up and I sell it and I take the profit. It's the same thing. Well, on the other side of that fence is somebody who's issuing or writing that option, creating that option, or what they call in the market, you're selling a call or you're selling a put. And why would you do that? Well, if you're sitting on 100 shares in your investment portfolio, along with the dividends, along with the value of that stock going up, right? You can also sell an option, and what that means is the premium, the price you're paying for that someone like me pays for that option. See, I'm not buying the stock when I buy the option. I control 100 shares. So you're temporarily letting me control that 100 shares of that stock, and then later on I sell it. I'm never going to buy those shares of stock. So what does that mean? Your 100 shares, along with getting the dividends, along with going up in value, you are collecting a premium and in other words, you're collecting more money. It's a secondary income off of those same shares. Now you go, well, I don't know anything about this. Well, go study it. It's not that hard, So so here, for example, sell options on Coca-Cola or Procter and Gamble. This can add an extra 2 to 5% annual income without taking on excessive risk. The worst that's going to happen is some knucklehead's going to go, ooh, either whatever, for whatever reason, they take that, they they exercise that option. So let's say the price of your Procter and Gamble's maybe $1 higher at that particular time, and some knucklehead goes, "Well, I want to own the stock," and they exercise that option. So they buy those shares. They're buying those shares from you. Okay, the option contract is where you got that premium. So it's not like they're just taking the shares from you. They're buying them. They're just buying them for slightly under the current market value. But you've been making money and making money and making money, so you turn around and buy it back. Did you lose a little bit? Yeah, but the probability that that's going to happen in today's market for options is very, very low. I don't know anybody who goes out and buys an option because they want to secure the shares. They're buying the option because they want to make money off the option, and eventually it expires worthless, i.e., your option that you sold or you issued, however you want to call it, just basically goes away. So what do? You turn around and do it again. All right. So, how often can you do this? Well, they have options that are what they call zero uh, DTE. That's days till expiration. So, in other words, if you're sitting on 100 shares of Coca Cola, you could sell an option today, make some money. It expires at the end of the trading day. Nobody's bought your shares. They used that option. Tomorrow, you sell another one. You get money for that. That's what I would do personally. But do you have to do that? No. There's people I know people who sell options that are like 20 and 30 days out. Now, I don't know why they go so long. Maybe there's a reason. Go do your research. I don't sell options, so I haven't done a ton of research. I just know this is an option. This is a strategy that people use for making money off of options for the shares of stock that they hold and that they possess. Okay, so again, it's a two-legged approach to your safe investment portfolio. Something to think about. Well, I hope this has helped you, and I hope you have a great day. Talk soon. Bye.